Kathy Woods believes over the next coming months and into 2024, deflation will set in for the U.S. economy. This could be good and bad. A little deflation could be a positive thing. A lot of deflation would surely mean a recession. Morgan Stanley's departing CEO believes markets will take off once the Fed officially says they are done raising interest rates. But if you've been in the markets over the past 3 days, each and every single day, you have seen a pretty aggressive intraday or end of the day sell-off. What does this mean about stocks over the next coming weeks? And what's in store over the next coming months and in 2024? We have a lot of data to throw your way. We have some clarity. And I think ultimately, you're probably going to like this if you are bullish. Maybe not. We'll see. Let's get into it, guys. Hit the like button and subscribe to the channel if you guys want to stay up to date and informed almost each and every single day on everything that's happening in our markets, good and bad. So Kathy Wood of ARK believes deflation is likely in the coming year, expects aggressive interest rate cuts by the Fed. And this was in a CNBC interview. She said this on Friday. Now, a little bit of deflation, probably good. That probably spurs the economy, spurs the consumer into spending a little bit more money. As a collective, that's good news. A lot of deflation is not good. Think about it like this. If Apple is having to cut prices, so they're getting less revenue for every product they are selling you, that's good because you can buy a product cheaper, but give it some time and Apple will start laying people off because, Wall Street's not going to like the fact that Apple's revenue is declining, even if there's deflation, and we should expect that. Maybe that's even good news for the economy at the same time. It will not be seen as a good thing for markets. I think your Magnificent Seven names are, well, the ones that are really holding up the market. So if they start to see deflation, they start to have to cut their prices, that's going to be a bigger problem for the broader markets. That's why I say a little bit of deflation, not a big deal. A lot of deflation, that's a problem. Goldman Sachs even says they can now imagine in 2024 less than 2% PCE. That would be great and likely give you a ton of rate cuts. Carl from CNBC reshared this post from Renaissance Macro Research that says core PCE inflation is up 1.87% at an annual rate over the last 6 months as of November. Between used car and truck prices and housing rents, there is room for inflation to remain benign. We continue to see the Fed cutting its policy rate in March. When you look at the PCE number for core month over month that came out Friday at 0.1%, that is 1.2% annualized. That is helping your 3-month and your 6-month annualized run rates to continue to fall under 2%. And if we get a couple more of these 0.1%, 0.2% rating, maybe we throw one of those in there. In 3 to 6 months, you're going to be under 2% for core PCE. And that will prompt the Fed to aggressively starting to cut interest rates. Maybe not 25 basis points at a meeting, maybe 50 basis points. If the economy looks a little weaker, maybe 75 basis point rate cuts. And that should spur your interest rate sensitive names, your small mid-cap stocks, the stocks that I think will do well in 2024. But in the near term, Friday kind of told us we might have a problem. Stocks might actually pull back a little bit from here. Considering core PCE month over month came in at 0.1%, that was lower than the estimate of 0.2%. Stocks on Friday really didn't do much. All in all, you were basically flat for the NASDAQ, basically flat for the S&P. At one point, you did see that end of the day kind of intraday sell-off that took indexes down about 1/3 at the lows. Sure, you did get a pretty aggressive bounce and you recovered, but for the bulls, you wanted to see a very strong day on Friday based on that PCE number. That did not happen. So we are very vulnerable here for a larger pullback. All things considered, as per the Buffett indicator, stocks are 175% potentially overvalued. You have a higher valuation for the Buffett indicator than you did during the dot-com bubble of the 2000s. You are at 175% of market value to the ratio of GDP. Basically, the numbers here, $48.41 trillion of U.S. stock market value. This is the market cap for the U.S. stock market. Annualized GDP at $27.7 trillion. Approximately 1.4 standard deviations higher than the historical trend line. Just meaning you're pretty overvalued right here. You were higher in 2021, but that was mainly because the economy was getting back to where it was pre-pandemic, and there was a lot of money flowing into stocks at the time. But this is one of those indicators that is not like, hey, we have to fall immediately, but you are pretty extended right now. At the same time, the S&P 500 was very extended on the RSI. That stands for the Relative Strength Index. You were at about 83 until last Wednesday's flash crash-like event where stocks were up over 0.5%, ended up closing the day down over 1%. I believe it was like 1.25% down. That reset a lot of your RSI readings, but you are now again overbought on the RSI at 71.40. And since Wednesday, it looks like the markets are looking for a reason to give you a larger sell-off and or correction. Sonyu Varghese says rate cuts are coming into a strong economy. Over the last 3 months through November of 2024, disposable income, 4% boost. Annualized. Employee compensation up 5%, PCE inflation at 1.4%. Real personal income, excluding government transfers, up 3.9%. One of Ryan Dietrich's favorite charts. Disposable income and compensation growth outpacing inflation. This is great news. It doesn't look as good on the 1-year chart, but the 3-month chart, I mean, it's stellar. PCE inflation is basically gone at this point. And here's a couple different positive stats for bull markets. It says Kupak curve cross, monthly MACD cross, Degroff thrust, Whaley thrust, Zwig thrust, 90% of S&P stocks above their 50-day moving average, Summination Index 900 plus, and a golden bull composite upon Friday's close. No guarantees, but we likely go higher from here. Even New Edge Wealth, which they tend to stay a little bit more on the bearish side or conservative side when it comes to inflation, they say, quote, the euphoria in the bond market has been largely based on the deflator 6-month annualized rates that now look like they could be undershooting the Fed's target in the next few months. Bond markets are currently pricing in 1, 2, 3, 4, 5, 6 rate cuts in 2024, almost pricing in 7 rate cuts. 7 rate cuts is priced at 34.4%, 6 rate cuts at 37.3%. So you're getting pretty close to pricing in 7 rate cuts. This could just be due to inflation falling faster than expected and the Fed needing to cut rates massively in 2024 just to make sure they're not overly restrictive on the economy. And if you do see the economy start to take a downward slope, that's where you have a problem for stocks, but potentially, good news for interest rate policy. That would price in more cuts, but maybe you would get a larger sell-off in the markets. Even more recently, Tom Lee with Fundstrat expects the Russell 2000 small cap stocks could rally 50% or more in 2023. I agree with that. He also shared this post from Mark Newton. Mark Newton writes, IWM finally managed to achieve its long-awaited weekly close above prior peaks going back since spring of 2022. We've seen both absolute and relative breakouts versus SPX at this point. While gains shouldn't prove uninterrupted, we do finally have a window for small cap outperformance next year. And you can see this very clearly. When you start to break above rejection levels, whether it's one-day chart, weekly charts, monthly, yearly charts, that tends to give you a larger kind of move in that upwards direction. Same thing to the downside. If we were finding support at this level to the downside and broke under that, that would likely be an indication you were going lower from there. Well, this is now an indication we are potentially going to go higher on the Russell 2000 and maybe much higher. But the biggest danger for our markets right now is, simply put, the data starting to show we might head into recession. See, recession is feared as this big negative catalyst that causes stocks to fall, but it's not actually a recession that causes stocks to fall. It's recession fears. Recession fears come long before a recession comes. That's why stocks mainly sold off in October of 2022. Everyone thought a recession could start in the first quarter of 2023 at that time. What happened? In the fourth quarter of 2022, stocks sold off and hit their bottom. And then we kind of wait to see if a recession comes. So you get the sell-off, you kind of wait and see what happens. You either get a rise if there's no recession, or if you get a recession, you could fall further. But a majority of the loss comes before a recession, at least for stocks. I think personally that sets the broader indexes up in a vulnerable position over the next coming weeks, the next 3 months or so. But once we actually realize we're not heading into a recession in 2024, I don't believe we're heading into a recession, that sets the markets up for a lot more capital to come back into stocks. There's probably $15 to $20 trillion of cash on the sidelines that, a portion of that could head back into markets. Just a small amount of that cash coming back into markets could send stocks up dramatically higher. Also, I wouldn't be surprised if your indexes, your SPY and the NASDAQ, which are 30-40% weighted to the top 7 stocks, well, if those top 7 stocks start to see outflows because maybe it looks more attractive to invest in small mid-cap stocks, interest rate sensitive names, you could see no sign of a recession, but you could see money go out of big tech, magnificent 7 names, into small cap stocks. That would drag down the broader indexes, but you could see a rally with 95% of other stocks in the markets. That could be an interesting dynamic that could also play out into 2024. And again, if we did see some kind of correction event for the SPY or the triple Qs over the next 3 months or so, it does not necessarily mean interest rate sensitive small mid-cap stocks need to sell off. You could actually see those stocks hold up or do good during a correction event, something that I will be watching for very closely. Let me know what you think about this information down below in the comment section. If you made it to the end of this video, you might as well hit that like button as well as subscribe to the channel. Consider turning on that notification bell if you guys want to be notified every time a new video is released. Nonetheless, thank you guys for watching. Enjoy the rest of your day, and I will see you in the next one.